Hello everyone and welcome to eToro Australia's Q4 Investment Outlook, time to value. We're here to tell you everything that you need to keep an eye on in Q4 after what has been a pretty amazing start to this year. We're also going to run you through quickly what happened in Q3. A quick reminder before we get started though that this is a marketing communication. It should not be taken as investment advice, personal recommendation or an offer of or solicitation to buy or sell any financial instruments. And a quick reminder while you're here as well to head over to YouTube, to head over to the podcast and make sure to give us a follow and subscribe to stay up to date with all the latest content. And if you're not already, give us a follow over on eToro's Twitter as well. So looking back at Q3, look, what a year it has been for the S&P 500. That rally did continue into Q3, but it did slow a little bit. It posted a 5% gain, though, which I would say is still pretty solid. But it was outperformed by the Dow Jones. The tech-heavy Nasdaq did fall by 1%. European markets gained slightly. The Japanese Nikkei lost 6%, obviously, after we saw that carry trade unwind throughout Q3. The ASX 200 gained more than 6%. China's economy is still coping with the property crisis. They are seeing declining house prices. We've got pressure on retail sales, manufacturing output, and subsequently commodity prices are sort of contributing to lower inflation levels worldwide. However, the region itself is still dealing with deflation. Recent numbers coming through still show that is a struggle. We, of course, did get recent stimulus measures as well, which we'll get onto throughout this episode today. A weaker economy in the US allowed central banks to begin cutting interest rates. Inflation lowered and unemployment rose, and that saw central banks believe it was the time to support the economy. The Fed made its first cut, 0.5%, with more ahead. The RBA, however, kept a hawkish stance and did leave rates on hold. We are at a slightly different junction to the rest of the world. Sector and asset class rotation started and it may continue to have legs. Rate sensitive and 2023 lagging sectors such as real estate and utilities outperformed the S&P 500 in Q3. Lower rate expectations supported bonds and gold whilst weakening the US dollar. And we began to see the rotation into smaller cap stocks with the Russell 2000 outperforming most other markets up 9% in Q3. A quick look, though, at something that I found really interesting in the third quarter. The ASX 200 ramped up its performance and actually outperformed the S&P 500, not something we see all that often. The technology sector led the way. Of course, that was driven from Wall Street. But what was interesting to see was that we started to see the rotation into those rate-sensitive sectors and the lagging sectors that I mentioned, such as real estate. We also saw strong performance from the heavily weighted materials and financial sector, which really helped drive the outperformance against the S&P 500. So although we haven't begun to sort of see really that shift from the RBA just yet, investors are positioning for what is ahead. So Q3 into Q4, we're going to have a quick look at the broader performance in Q3. China led the way thanks to the positivity from the region over the last month. But as mentioned earlier, real estate also led the way. The dollar sank with the Fed's rate cut expectations growing, and it was warranted with that 50 basis point cut that we saw. For the rest of the year, plenty to watch moving forward. We have Netflix earnings this week and towards the end of the month, big tech earnings. It's then an important quarterly inflation report from Australia, straight into elections in the US at the start of November. The RBA board meeting at the start of December also remains a very key one to watch. So plenty to keep an eye on in Q4. So now we're going to have a look at some of the drivers in Q4. We see the Fed cutting further and bringing the move to neutral interest rate. The Fed sees US GDP growth at 2% and interest rates at 3.4% by the end of 2025. This supports bond markets and a more balanced view in terms of valuation across equity sectors. But so far, we see the Fed continuing its easing cycle in Q4. Double-digit earnings growth will continue, and a seasonally strong Q4 earnings growth is seen at 15% for the S&P 500 and 12% for the Stoxx 600, driven by previously lagging value sectors and quality tech. The bottom line to both those points, though, is that the fundamentals remain in place. So those first 2 points we mentioned there, GDP and earnings growth. We've seen this year that if we get a dip from the S&P 500, it is bought up, and it's bought up quickly. Investors are focused on earnings growth, rate cuts, and that US GDP remaining robust. Looking back to Australia, quarterly inflation is key to the RBA's next move. The RBA has talked a tough game in Q3, and it continues to speak about the upside risk to inflation. Quarterly data will be key at the end of the month here in Australia, so that's going to be at the end of October. Michelle Bullock said that Australia won't get a rate cut until 2025, and that is looking very likely. But we look to February for that first cut, as long as data continues to support it. Lithium is potentially moving from a winter to spring. We've been in a lithium winter for a very long period, but Rio Tinto's recent acquisition of lithium miner Arcadium Lithium puts lithium back into the spotlight. China is also adding stimulus, and this could set up a better Q4 for lithium miners and more broadly the material sector in general. We've already seen rallies from smaller miners such as Pilbara, Core Lithium, and Liontown Resources. So although we may not have seen the end of the weakness, it might have been the bottom for lithium prices and maybe the lithium market. So something to keep an eye on in Q4. And historically, Q4 has also been the best performing quarter for Bitcoin. After getting through September, seasonally the worst month for Bitcoin unscathed, Q4 looks set to be a solid end to the year. We've got more rate cuts allowing capital to flow into risk assets such as Bitcoin, and institutions are understanding the product more, and it's certainly an asset to keep watching as we move into the last quarter of the year. So a quick look as to what you are saying as investors. Look, really not a huge change from investors as we head into Q4 in terms of assets. Crypto has picked up slightly while real estate also gained. The US market's pulled ahead with a focus likely to be on those incoming rate cuts. On the sector side, tech has lost a lot of dominance, which just points to the rotation that we've discussed into those rate-sensitive sectors. Financials, real estate, and healthcare, are really pushing through there. We had energy also getting a big boost as well. We've seen a lot of volatility coming from oil prices over the last month, which would be maybe a reason for that. But that then also flowed into our themes as well. Investors are taking some profits on the disruptive tech names and instead looking to up their allocation to crypto assets. And as we say, we believe a more positive Q4 for crypto coming through. So finally, to finish us off, our 2024 investment outlook. We believe a rotation to broader market is happening. Tech valuations have come down from unsustainable levels. Tech has been the crowded trade. Even a modest sell-off will cause notable price increases of assets in other sectors and region. AI will, of course, remain front and center. Earnings season will remain highly important, and ASX tech stocks will continue to track that of the US. Rate cuts overseas have arrived, which puts bonds into motion, cash to follow. Bonds will do well as interest rates are seen to decrease. Cash will seek higher returns for longer by moving to bonds and defensive dividend-paying stocks, contributing to the rotation. This is going to be a focus for the US market, but locally we will continue to see that early rotation into cheaper sectors that we've mentioned that the US has already seen. And we may also see investors stay a little bit in cash given that our cash rate has continued to stay high. A weaker US dollar will help other asset categories like commodities. We've seen a peak in the US dollar, and that's going to offer relief to other currencies like the euro and the Japanese yen. A softer US dollar will often support emerging markets and commodities. And as I said earlier, keep an eye on miners locally. They've been unloved this year, but we have started to see a rotation into materials from financials. Financials has been a very, very good performing sector in 2024, so we might see a bit of capital flowing into some of those other sectors. Earnings growth is still strong, but we're going to see it be a little bit more balanced across sectors. It's still strong in developed markets as companies have taken measures to adjust to higher rates. Lower rates will give relatively more relief to rate-sensitive sectors and regions as well. Look, plenty to watch as we follow into the start of next year when we get to reporting season here in Australia as well. We will be watching those sort of real estate names, the healthcare, etc. We could see that performance sort of coming through at the start of next year also. Crypto, finally, as well, as I mentioned earlier, we're seeing that set to benefit from higher institutional investor participation. We see ETFs gaining further traction in Q4 and into 2025, as I mentioned earlier, as we continue to see institutions understanding the product more and how it fits into portfolios. So look, a really exciting end to the year, plenty to watch. To stay up to date with all the latest content, head over to the eToro Academy. Stay tuned to the podcast and our socials. We will cover everything for you. Follow me on eToro as well, Josh Gilbert 9 for daily updates and to ask any questions that you might have. Thanks for watching and see you soon.